Welcome to the Old Capital Real Estate Investing Podcast with Michael Becker and Paul Peebles. During this program, you will hear interviews with real-life successful investors who will share their stories and provide useful advice on how to acquire, finance, and operate apartment complexes. Now, here they are, Michael Becker and Paul Peebles.
Welcome to the Old Capital Real Estate Investing Podcast. I'm your host, Paul Peebles, National Underwriter for Old Capital. And typically joining me would be the mayor, the governor of the great state of real estate of Texas, Mr. Michael Becker, but he is on another due diligence assignment. So we have the professor in the house today. The professor, as you know him, Mr. James Eng. James, how are you?
I'm great. Just enjoying some cooler under 100 degree weather here in Texas. So it feels fabulous.
It is a little bit under 100 degrees. Maybe it's 98 or 97, but it's still relatively warm. Talking about something that's hot, James, we have the Old Capital Conference coming up next week, October 4th and 5th. Last moment thinking, people who haven't gotten their tickets, haven't RSVP'd to come to the Old Capital Conference, the premier event of 500 plus investors in Texas through the Southwest. People come from all over the United States to come to the conference. This is the 7th annual conference. James, tell them a little bit some of the reasons why people should come to the conference.
Yeah, I think what's different about this conference is, you go to a lot of conferences and, it's somebody from Blackstone or somebody from this big institutional equity firm. But in reality, they don't actually invest their own money in any of these deals. And, they sit on a committee and make decisions like that. And there's nothing wrong with that. Like, I worked at GE for a long time and everything was by committee, and not a single person on that committee put a dime in any deal. And so I think what's different about the Old Capital Conference is that pretty much everybody walking around that you're talking to, they're a limited partner, they're a general partner, investing in deals, putting deals together, and they own stuff already. So they're in the arena, like they say in whether it's Gladiator or whatever president said that. They're in the arena fighting the battle day in and day out. And so the people that you're going to talk to, they own deals in Dallas. They know, what's going on sort of on the street. And you're not going to hear some corporate mumbo jumbo similar to this podcast.
Yeah, unless you listen to this podcast, and then we'll talk a lot of jargon and corporate mumbo jumbo. How do people get a last minute ticket to come to the Old Capital Conference, James?
Yeah, go to oldcapitalconference.com. You can register right there, get yourself a ticket. We've got happy hour on Wednesday night. That's sort of like an intro. That's, I think, Paul and I's favorite part, or my favorite part, because we're just running around catching up with people. I think we got 3 hours. So pace yourself out there for happy hour on Wednesday night in Addison. And then we're going to be at the Frontiers of Flight Museum all day Thursday. So try to get some sleep on Wednesday night. And then Thursday, come in. We'll start about 8 a.m. And, we'll have a state of the market. We'll have listing brokers, lenders, property managers, general partners about what's really going on and how people are putting deals together right now. And one of the things that we're going to be getting into is how are people sort of working their portfolio right now? Because I think that is an important part, is if you can't perform on your existing deals, it is going to be very difficult for you to go out and raise equity on new deals. So we're going to bring in, 4 or 5 general partners to talk about how they're managing their portfolio today.
Yeah, it's going to be a great event. We look forward to seeing you there. If you can make it to Dallas, come and see us, and we'll make sure that we have you spend some time in meeting other people. This is a great networking opportunity. So Old Capital Conference, oldcapitalconference.com. Go and get your tickets.
And I forgot. So the keynote speaker this year is Chris Cassidy. So Chris Cassidy, he's done, I think he's had like 3 lives. So he's already been a Navy SEAL. He's already been an astronaut for 15, 20 years, been up to space 3 times. He is coming in to speak with us about what it is life like. What is life like up in, I think he's been on what's the big thing called? The
International Space Station.
Yeah, the space station, and sort of working through issues. We think the business is hard, but we have gravity down here, and there's a lot of things. Most of our situations are not life or death. So he's been in multiple situations where it is life or death, and he's going to share some of those stories about whether it's when he was in Afghanistan, whether it was up in space. I think he spent over a year in space and working with different team members across a lot of different, I guess, missions. And so he'll provide a little bit different perspective out there of how to sort of work with teams. I mean, I don't know if, I guess maybe everyone spoke English on those missions, but just how to work with teams that, are coming from a lot of different countries.
Sure. Well, talking about life and death, James, have you ever watched a war movie? I mean, a real war movie?
I think the only one I've watched is Saving Private Ryan.
Saving Private Ryan. So that was with Tom Hanks. I've seen, some John Wayne movies of the Sands of Iwo Jima. I've seen a couple of the Rambo movies or so, and then Bradley Cooper in where he played Chris Kyle, and they kind of demonstrate the true American patriotism and going to battle with a bunch of your buddies. But I've never been in combat, and James, you've never been in the service, right?
No, I have not.
So, in fact, I haven't been. It's been a long time since I was actually in a fight. I mean, a physical fight. So I just don't do that at all. I'm too old to get into fights. But and I haven't even fired a gun in a while. Even though I live in Texas, you would think I would be firing guns every weekend. But no, I don't fire a gun. But I feel that we, as investors, are in a battle, a land battle, that we're in a foxhole trying to understand the dynamics of war. We keep on getting shelled on or fired upon by forces we cannot control, like higher interest rates. Interest rates have gone from 3.5% up to 7+%, some cases even much higher than that. They've doubled. We've had property taxes, especially if you live in Texas, property taxes have gone up. We've had insurance. When we used to underwrite deals back 2-3 years ago, insurance was $350, $400 a unit. Now it's $1,200, $1,300, $1,400 a door. We've had higher interest rate caps. If you did an adjustable rate non-recourse bridge loan a couple of years ago, you had to pay for an interest rate cap. That's the insurance to keep your payments fixed, and that's gone up 40 times since the initial closing. We have a lack of partnership liquidity. We have loan maturities that these loans were not for 10 or 15 or 20 years. They were for 3 years if they were adjustable rates on the non-recourse bridge stuff. We have debt yield hurdles that we have to meet. We have lower cap rates and value concerns. So today I really want to talk about is the good things to think about during a battle. So we know the bad things that are going on right now, but I want to have kind of the thinking about what are the good things to talk about when you're in the foxholes. And so we're with you in those foxholes. So we're coming back with the message back to the commanders. And so I'm Corporal Peebles, and Lieutenant Eng and I we've jumped out of the foxhole temporarily, and we're going back to having a briefing with our military superiors and kind of giving them ideas, and they're giving us ideas too. So really the top of the conversation is when you're in the foxhole with your buddy, is that all things sometimes look fairly dark and dim. And again, there's never an atheist in a foxhole. So you have to have faith about what's going on. And I thought what we would do today with Lieutenant Eng is kind of talk a little bit about the good things during a battle. So James, let's talk a little bit about some of the good things that are happening right now and are going to happen in the future for people that have invested in apartments and then are going to invest in apartments or real estate down the road. So give me some things.
Yeah, I mean, I think there's two classes of investors right now: people who have invested and people who have not invested. So let's talk about the people who have invested. The people who have invested, they've had a hell of a run. Right? I mean, I started in this business in 2015. From 2015 to 2020, cap rates compressed. Rent growth was pretty steady. You could get 75, 80% leverage on your deal on a fixed rate. And then COVID happened, rent growth went to the sky, 20% rent growth. So people who have invested in this business, they've seen prices just go parabolic almost, and they have made a ton of money. Some of the guys who have come in sort of late in this cycle, 21, 22, they are in a different boat. because for the first time in 10 years, we're seeing prices come down and interest rates go up. Whereas before, it's almost like people forget that interest rates could be at this level. But in 2006, 2007, interest rates were at this level. So it's not like it's something new, but it just comes at a different time. And, everyone thinks the good times are going to keep rolling forever. So I think there's one boat where the investors who are sort of have been in this business, they have a couple skins on the wall, they've sold some deals, and now they maybe have one deal or two deals that have an issue. To those people, they've just got to make it through the next probably 12 to 18 months. And the thought is not only is the rent growth going to be probably flat for the next 12 months or so, is the occupancy is probably going to be around 90%. You're going to have to sort of run your property well and make sure you're on top of things to make sure that you get through the next 12 to 18 months. The people who are coming, I would say, that are just brand new, this is like the start of a new wave, a start of a new cycle to some extent. I think we had Greg Willett maybe 6 to 9 months ago. I can't remember when we had him, but it was almost like the beginning of a new cycle. And prices have reset probably 20%, maybe 30% from where they were. And this is the new class of investors to come in and buy these deals. There's going to be a lot of people who came out of, this recession. I mean, a lot of people came out of the last recession, right? So some of the largest syndicators that we know grew up in 9, 10, 11, and 12. And they own 20, 30,000 units right now. And so I think this is a huge opportunity for people who don't have any legacy assets to come in. And the thing is that you're new right now. So you have the struggle of everybody else are defining yourself in that, all right, how are you going to raise the equity? This is not easy equity raising time. How are you going to qualify for the debt? The debt is expensive. So I think everyone just looks back on 8, 9, 10, and 11 was like, I should have bought everything. Well, it's hard to buy everything because you couldn't raise equity and you couldn't get a loan. So, I was at GE, we pretty much stopped giving loans from 2008 to 2011. And in that space, how do you go out and buy deals? And we haven't gotten to that point in this cycle, right? There's still liquidity in the market. There's still agency loans to be done. You can still do a bank loan, right? I think, we're closing 2 or 3 bank loans in the next month or so. So bank loans, agency loans, they're all still there. It's just at what price? And so a majority of people who are coming into this business that are new, to me, it's all about your team and figuring out how to position yourself to buy these deals that are in distress.
Let's go back to the first wave of people that are currently into these deals. Lieutenant Eng, you're back talking with your commanders in the back. And when you're running back, you're thinking that we need to have some more bullets. And so you report back to your commanders and you say, we need more bullets. And really bullets is liquidity. We need more money to get into these deals. Talk a little bit about raising capital these days. And that other thing is too, these battles don't last forever. So I don't think we're going to see longer interest rates for a long period of time. And I don't know, and I have a degree in economics and a master's in economics, but I can't tell you what the Feds are going to do tomorrow. We just don't know, but we have to prepare for things. But talk a little bit about how liquidity cures a lot of problems.
Yeah, I mean, I think the challenge right now is that most people who have floating rate loans, let's say they have a $20 million floating rate loan, to get into a fixed rate right now, you're probably going to have to bring $3 million, $4 million, $5 million to cure that problem. And there's a Band-Aid. So the Band-Aid is you just buy an interest rate cap that maybe costs you $500,000 to $1 million. That gets you 1 year. So you're trying to figure out how sticky is this Band-Aid, and you go in the shower, that Band-Aid's coming off, right? So the super glue Band-Aid, getting into a fixed rate is going to cost $4 or $5 million. And so a lot of the general partners that can raise that equity or have that equity are fixing that problem as soon as they can. And so whether it's been the last 6 or 12 months, when you do a capital call, I think with a permanent solution, then you sort of stop the bleeding on that deal. And that gives you the opportunity to move to another deal. But I have not seen much success on doing capital calls for the short-term Band-Aid, because the limited partners are going to say, well, we're going to give you the $1 million or $500,000. And then 12 months from now, you're going to come and ask me for another $500,000 or $1 million. Like, how are we getting out of this deal? So I think if you can get to the permanent Band-Aid, that would be my recommendation. But you do have significantly more equity to raise. And one of the things that people have been doing is they have offered that up to their limited partners. If their limited partners do not want to be in that deal, or they just, for whatever reason, they can't participate in that deal, you can't raise the money, there are other equity providers that can provide that money. So whether it's preferred equity or some sort of mezz loan, we're having people come in and take that sort of second tranche behind the first mortgage. And so right now, this business is hard, and the next 12 to 18 months are going to be harder, but you're going to have to come up with solutions that you didn't think when you bought this property 2 years ago that you were going to have to do. I think that's the main point, is that, this business is easy when you buy on a 7 and sell on a 5 cap. But when you buy on a 4 and you sell at a 6, it is extremely difficult.
Back, say 2-3 years ago, when people were looking, that had just gotten into the market itself, they had seen all their friends, all their relatives, their brother-in-law that had made some money in the multifamily space. And they're like, I'm getting into that. And so they put their money and invested with a general partner that may have done 1 or 2 deals prior. And the general partner found a transaction to buy and then called you to get into the opportunity to invest in this deal. And at the period of time, back 2 years ago, 3 years, 2.5 years ago or so, that general partner was given an option by the lender. And it could have been a lender who was offering the debt. You can put in 40% down to get this Fannie Mae loan, 40% down today, because that's what the NOI is going to qualify this sales price for. Or you can do this non-recourse bridge loan, because you don't want to keep this property for a long period of time. You just want to buy it, rehab it, and then sell it, flip it in 2 years, and you don't want to have this long tail of a prepayment penalty on it. And by the way, you can do it with 20% down. And then the general partner is like, well, why would I want to put 40% down when I could put 20% down? They're still both non-recourse loans. I still get the funding on the deal. And I think interest rates are going to remain the same for the next 5-6 years, and because they've been low for the last 5 or 6 years prior. Well, today we're going back and saying, that 20% you put down on the deal, well, we need the other 20% to make this deal work again. So we've been at the table, we've had a beautiful meal, and now the bills come, and now we have to put what we should have put down back 2.5 years ago. We're going to have to pay the rest of the bill right now. So that's really what a capital call is that we're not expenses. We're kind of paying down the balance of the loan to what it probably should have been back 2 years or 2.5 years ago. So it's not expenses. We're paying down the unpaid balance. So it comes into line to what the NOI is, what the current interest rate is, the term is out there, and that is generating what our new loan is going to be. And typically that's going to be 40% down, 35 or 40% down. Any more comments on that, James?
What in that same scenario, so most people, when they start in this business, they start with maybe a $5 million deal or $10 million deal. What happened was that you do a $5 million deal. The next deal you want to do is a $20 million deal. And after you do a $20 million deal, you want to do a $100 million deal, because the economies of scale, Paul. It's obvious. Just do a bigger deal. The challenge is that now I was at a conference earlier this year. It seemed like every single person who had been in this business, they did a bigger deal. The biggest deal that they had ever done was done in 21 and 22. Everybody, because prices went up and the debt went up. But the example that you give, I'll do a spin on that example real quick, is that The whisper price on that deal was $10 million. And the Fannie Mae guy said, I could give you $6 million. And the bridge guy said, I could give you 8. Then it went to best and final, and then it went to 12 million. Then it went to best and final of the best and final, and it went to 14 million. And the Fannie guy said, I could give you 6, and the bridge guy said, I give you 12. That's the part of the 20% that moved. And unfortunately, that price is now still 10. So the NOI on the properties have gone up in the last 2 years because of rent, but the price, the value of those properties, because cap rates have gone up, is still $10 million. And so now you have to get back to the Fannie guy still saying, I got a $6 million loan for you, but your bridge loan is 12. So that is the challenge, is that the pricing moved so quickly and there's too many people trying to bid on these deals that the pricing just kept going up and up and up. And right now what we're seeing is whisper price is 35 million and people are coming in at 30 or 31. And the seller's saying, forget it. If I can't get 35, I'm just going to keep it. So unless there is some sort of motivation from the seller right now, they are not going, because the cap rates have moved too fast for them to take a loss on their deal right now.
Would you say small is the new big?
Well, when you can't raise as much equity, yes. Right. So before, I mean, people are getting $20, $30 million equity raises done in 2 weeks. That is not the case anymore. It's taken 2 months. So majority of the people, and a lot of those $20 million equity raises were done by institutional guys writing one check and put 90% of the money in. Those guys have not reappeared yet. So on a lot of these deals, we're seeing more activity on the $10 million deal than the $50 million deal. So right now, small is the new big. So if you do have a smaller deal out, it probably makes sense to take it out right now if you are done with that smaller property. But, you know, there's not going to be as much distress in the smaller stuff because, one, most of the bridge lenders wanted to do loans over $10 million. And so, you know, when I was at GE, there was, 10 guys in our group. And if you brought us a $10 million deal or a $20 million deal, we did the 20 because we needed to get to $1 billion in our year. And the 10 million took probably more time than the 20. So these guys just did bigger loans. And so a lot of the bridge stuff is on larger properties, probably 10 to 15 million loan amount and higher. So there's not going to be as much distress on the small deals, and it will be easier to raise the equity. And that's, people will start going back to those deals because those are the deals that they can get done.
And at lower leverage too.
Right.
So talk a little bit about, maybe there's been a deal or two that, and again, these are legacy deals. Let's define legacy versus new stuff. Legacy would be something that somebody has owned for 3, 4, 2 years in the market. Brand new stuff is just like you would, if you're a new investor coming into this market itself, would be a new investor. Some of the legacy investors who bought properties that did the higher leverage, that just when they did the rehab of the property, they just couldn't get the rents and the occupancy up. Talk a little bit about 80% occupancy and what occupancy can do to hurt you in the future.
Yeah, I mean, we've seen some foreclosures in Houston. It seems like one a month in Houston this year. It's not just, sometimes it's operations, right? So if you don't give enough capital to some of these projects, it just goes down a spiral. Other times it's just location. Sometimes it's just too much debt service. When, you got a floating rate loan and you didn't buy an interest rate cap, all your money's going to the debt service, and then you don't have enough money to feed the property. So, we saw probably in the last month, a couple of deals post for foreclosure. And, you go on and you look up the occupancy of those properties and it's 75, 80%. And you remember your expense ratio is about the same, right? So if your expense ratio is running at 50, 55% here in Texas, with insurance, it might be 60% or 65%. And your occupancy is only 70, 75. And then not everybody's paying, you might not even, your NOI might be zero and you've got to pay your debt service. And so I think we've seen some larger portfolios worked out. Like, Tides was a huge buyer in 21 and 22. They sort of sent out a press release, I guess, by themselves saying that we worked out a lot of deals. Congratulations. But a lot of people aren't getting workouts. A lot of people are, they just can't make the payment anymore. And so they're getting foreclosed. So we saw 2 large foreclosures in Houston, $50 million on a bridge. And then also even a Fannie Mae or Freddie Mac, I think it was a Freddie Mac loan, got foreclosed next week because the guy just couldn't make the payment. So whether it's escrows, whether it's occupancy, and these are going to be opportunities for people to come in and just sort of reset the basis on these deals. And the hope, I guess, is hopefully that helps your taxes at some point if it's in your area, but it will probably hurt your rents, right? So if somebody comes in and buys a deal, you bought it for $150 a door, they come in and buy it for $100 a door. Now all of a sudden they can charge significantly less rent. And so they might cut some concessions to bring that occupancy back up to 90, and you're gonna have to deal with that for a little bit.
So it is not us that are in the foxholes as lenders, as investors with you. We've reported to our commanders, and now we're going to the foxholes, and we jump into the wrong foxhole, and we talk with some of the brokers. Now, James, you've been out on some broker showings, talking with some of the listing agents recently. Their heads down in the foxhole too. And what are they telling you as a fellow combatant in the foxhole?
I mean, these listing brokers are people are trying to get a feel for value right now. How do I value this property? And it's moving faster than anything, and it's moving in the wrong way. So a lot of times, let's say in 21 or 22, they would give you a BOV, say this property is worth $10 million. Okay, great. Let's go out, sell it. Then they would have the 40 tours and 20 offers, and they'd end up selling the deal for $13 or $14 million. Everybody was happy. Everyone's at Nick and Sam's having a great dinner. But now it's the opposite. They say it's worth 10, and then they take it out to market. Rates move up. It's worth 9. Then they get bids. People are coming in at 7. You want to sell the property at 7? Well, my loan's 8. So I'm going to have to bring $1 million to the table to sell this deal. I don't have $1 million to bring. Forget it. I'm not selling. I'm not going to lose all my equity. I'm not going to bring more money to the table as the seller. I thought the buyer is supposed to bring money to the table, not the seller. I'm supposed to take money from the table. So, it's been definitely harder. What the listing brokers are looking for are motivated sellers. So you can call it motivated sellers. You can call it market sellers, whatever you want to call it. It is guys who got to go. And there are some people in the market that have taken the stance that if it has equity right now, I'm okay selling at a loss. So they might have put $10 million in the deal of equity. And now, for whatever reason, the interest rate cap is coming due. The maturity on the loan's coming due. Something's coming due. They are okay taking 30 cents on the dollar right now. And those are the deals that you as a buyer should be chasing, and the listing brokers should be chasing right now. And it is painful for the people who invested in these deals to take a loss on a deal. But for the general partners in these deals, they're trying to survive to another day. And, I'm not saying that I want to invest in a general partner that has a bunch of losses, but if you've got 1 or 2 losses and then you've got 25 wins, I mean, it's still a pretty good record, right? And when I talk to you as a general partner, I want to hear the story of what happened and what you learned and what you're going to not do next time on a similar deal, because then you're going to be here in 2025, right? Some of the people who just wait and wait and wait, and if they get foreclosed, they will not be here in 2025.
2 things I think you brought up were interesting. You had just walked a property with the listing agent. Again, you're in the foxhole, and they had taken the listing, they'd done full marketing the property. They had done 40 tours, 35 tours, whatever that number was. They brought it back, and there was a couple LOIs out there, but they were below what they thought the target price was going to be.
Yeah, there was like 10 offers on the deal. They went to best and final, had everyone sharpen their pencil, the whole deal. Most people, when they're sharpening their pencil, a week later, the treasury moved up 20, the prices went down from the initial offers. So sometimes it's time to move on some of these deals quickly. So yeah. So they went through the whole deal. This is probably a 90-day, 120-day process. The staff is all tied up for 4 months answering all these questions. And then at the end of it, they said, forget it.
The seller said, no way, I'm done. thanks for helping us out, guys, but we're going to keep the property and we're not going to trade the deal.
Right. Yeah, these guys aren't motivated. So they don't have a maturity. They don't have an interest rate cap to come and do. They just thought, all right, I've owned the deal for a while. Maybe there's some money to be had here. Maybe put some money aside, sell the deal now and have money for another deal, but they just couldn't get to their price.
Listing agent just kicked the ground and cried a little bit in his beer, but they didn't get paid for the hours and hours and hours of work that not only that they did, but their staff did too. And it just did not.
I wonder if these listing brokers start taking a deposit on these deals. So, I mean, the lender takes a deposit, right? The lender takes a deposit to go on a loan app and do the whole deal. And very rarely, I mean, it happens, right, for the lender to do all the work and everything. But typically, you still got to pay. The attorney still gets paid. I guess that's the last thing. The attorney still gets paid.
Yeah. The other point that you were bringing up is valuation. What are these properties worth these days? And I think that is another key question. James and I have been in numerous foxholes talking with appraisers, talking with listing agents, talking with borrowers, talking with limited partners, and being lenders. If you throw out what your numbers are, the NOI on the property is, and what the expectations of what they think the whisper number is, you have 5 people in the foxhole, you're going to get 5 separate answers of what that property is worth. So James, really today, what is that property worth? How is the math calculated versus how it was back, say, 2-3 years ago, or even 10 years ago? How does the math work these days?
I think it's easier. The math is easier now. So in 21 and 22, when rents are growing 20%, nobody actually knows if I should grow rents 20% or 25%. Nobody knows, right? It's a guess. But right now, everyone's looking at the same numbers. And if rent growth is pretty much 2 or 3% year over year for the next year, then everyone's underwriting to that number. And so the math is actually very easy. The math is, I need positive leverage in this deal. And if I cannot get positive leverage, I'm almost not going to buy this deal. And so positive leverage means if your interest rate is 6%, then my cap needs to be 625. And that is tax adjusted, insurance adjusted. And we've seen people stomach a little bit of negative leverage. So maybe 25 basis points or 50 basis points of negative leverage. They feel like there's some sort of inherent rent growth or, bringing mark to market, bringing the rents up to market so that you can get to a positive leverage point. But that is the challenge when 10-year treasury is running this much, because if 10-year treasury was still 2.5% or 3%, a lot of deals would be getting done right now. A lot of refinances would be getting done. But where it sits today, your all-in rate is close to 6 to 6.5%, depending on, what structure you choose. And most of the people want to sell on a 5 cap. And so that disconnect, it's 150 basis points of negative leverage. And so that is just too much for people to take on. And it's very difficult for people to, we've seen some people try to sort of artificially drop their interest rate for a couple years, but essentially they are prepaying their interest by buying a lower strike. So, there are ways of doing it, but you essentially are just prepaying the interest on these deals.
And that's for maybe class B plus, A minus properties in terms of cap rates. But talk a little bit about where positive leverage has to be when you're buying a class C property. And is there anything called a value add property these days, James?
Everything's value add. I mean, if on an A deal, you're probably 5.25 to 5.5 here in Dallas. But the challenge is that most people still aren't bidding there, and we're not seeing enough transactions to really call a cap rate right now. And treasuries are moving faster than, prices are adjusting. Right now, on a B deal, you probably got to be 25 basis points, 50 basis points positive leverage. On a C deal, it's going back to the old days, right? Old days used to be, 5% class A, 7% B, and then, C's were at 9, right? Maybe it's a little bit tighter depending on the market that you're in. But there was a 150 basis point spread between A, B, and C. And so that compressed all the way down to 4.5, probably in 21. And now it's just coming back, right? So the line that we use is the gap is back. The gap is back from A, B, and C. The gap is back from primary, secondary, tertiary. And unfortunately, there needs to be a gap between what people can invest in treasuries and your cash on cash yield on these deals. Because I think, in 2015, 2016, almost everybody wanted double digit cash on cash. And so for people to get that cash on cash to be there on a C deal, you need to buy on a 7 or an 8 cap to buy and, get leverage at 6%. And then you can get to your 10% cash on cash. But yeah, it's challenging to get a seller there because they have to be motivated by something besides just making a ton of money right now.
That's correct. So we talked about a lot of things today. So we talked about a little bit about legacy investors. We're talking a little bit about new investors that are coming into the market right itself. And that's where we really see the opportunity during the battle right now of having the new troops coming in to kind of rescue the guys that are currently in the foxholes, so to speak. And they're coming in with brand new bullets, brand new equity that's going to come in, and the market is resetting itself so that the new troops will come in and do better. And some of the people, the GPs in the foxholes right now that have learned a ton of stuff about how to fight the battles, hopefully that goes down when they go to fight in another battle with your money, that they've learned something and that they're not going to expose your money to somebody that hasn't learned something. You can't have a bunch of losses, but you can have maybe one loss or two losses every once in a while. But hopefully you've learned quite a bit. Any final lessons, James, before we say goodbye?
Yeah, I think listing brokers have time. Buyers have time right now. And I would be I would still be out touring deals. I'd be talking with lenders. I'd be staying close to deals, because a lot of times when you stay close to deals in the past, it just went from 10 million to 12 million to 14 million. All right, we just moved on from that deal. But right now it's going the other way. So it's starting at 10 million, then it's slipping to 9, then 8, then 7. At 7, it might make sense for you to step into these deals. So brokers have to know that you are in the market and that you can raise equity. And so I would be figuring out, number one, who's going to be on my team to qualify for this loan, but then also how am I going to raise the equity? And then which brokers are going to be showing me deals to me? Because the brokers are hungrier than ever to get deals done, right? You can hear it in their voice because they're calling you back. So they are hungry to get a deal done. I think right now there's not as many deals, quote unquote, on the market. So you've got to be in front of these brokers. And a lot of times the broker tells you about the off-market deal when you're touring a deal and you're like, well, I like this one, but it's a little bit too big or it's a little bit too small. Oh yeah, this other one down the street, it's coming out in 2 weeks. Do you want to take a look at that one? And I think what's gonna, one of the things that we've always said is time kills deals. Before, as a broker, the longer a deal sat on the market, the price kept going up and up and up and up. Right now, as a broker, you want 0 time on the market. You want it to just go under contract right now. So I think people are going to start realizing that if there's a good offer, they need to just take it as a seller and get it under contract and start the process, because these deals are taking longer. We had lunch with a broker yesterday and the deal was under contract for 5 months, which was unheard of before 2000. Like in 21 and 22, deals were closing in 45 days and 50 days because the debt was easy and the equity was easy. Now deals are taking 5 months to close. So the sooner that when you get it under contract, that is just the beginning. So faster is better right now.
Why do people want to use Old Capital? What's the differentiation between somebody that works at X versus Old Capital?
Yeah, I think obviously we're going to take the deal out to multiple lenders to figure out what the best strategy is on that particular deal. A lot of the stuff, we just listened to JP Conklin's, and I thought he said it actually really well in his webinar. He's like, we support you throughout the transactions, between the transactions. So, all the stuff that we do, whether we look at 100 deals before you do your first deal or 5 deals, right? We're working with you after the deal closes, before the deal closes. And I thought that was a good differentiation point from him, is that because almost no other cap provider gives you anything, tells you anything, right? So, I think in terms of working with us, all the information that we provide to you as a general partner is inside information that you normally do not get. And so I think that is when you talk to people who work with us at Old Capital, after they do 1 deal or 2 deals, they finally understand it. And it is hard sometimes to show what we do. And I think that point becomes very obvious once you have started working with us. And so, find one other mortgage broker with 600 podcast episodes. There isn't one.
Not at all. All right, Lieutenant Eng, thank you very much. Corporal Peebles here signing out. Again, go to oldcapitalconference.com, oldcapitalconference.com. Join us October 4th and 5th. I know it's a short time, but try to get to Texas to see us. We'll make it worth your while to come to see the Old Capital Conference. Again, the professor, thank you very much. I appreciate it. Mr. James Eng, I'm Paul Peebles. Have a great day.
Thanks for listening to the Old Capital Real Estate Investing Podcast. Please join us at oldcapitalpodcast.com to sign up for our weekly email updates. We'll see you next week for another great interview.